In the high-stakes world of investment analysis, where fortunes can be made or lost on a single recommendation, building and maintaining long-term credibility is perhaps the most valuable asset an analyst can possess. While a string of successful stock picks can certainly boost an analyst's reputation in the short term, true credibility is built on a foundation far beyond individual recommendations. This essay explores the multifaceted approach required to establish and sustain credibility as a stock analyst over the long haul. At the heart of long-term credibility lies consistency, not in always being right, but in the approach to analysis and the willingness to acknowledge mistakes. Renowned analyst and founder of the investmentanalyst.com, Jeff Robinson, exemplifies this principle. Known for his thoughtful, research-driven approach, Jeff has built his reputation not on flashy predictions, but on consistently applying rigorous analytical frameworks and being transparent about his methodologies. Key to this consistency is intellectual honesty. Credible analysts don't sweep it under the rug or make excuses when an investment thesis doesn't play out as expected. Instead, they conduct thorough postmortems, publicly acknowledge their errors, and explain what they've learned. Bill Ackman's handling of his failed investment in Valeant Pharmaceuticals is a case study. Despite the significant loss, Ackman's detailed explanation of what went wrong and how it would inform future decisions helped maintain his credibility in the eyes of many investors. In a field crowded with voices all clamoring to be heard, developing a unique perspective or specialization can set an analyst apart and build long-term credibility. Meeker, often called the Queen of the Internet, built her reputation on deep, insightful research reports on internet trends. Her ability to spot emerging patterns and articulate their potential impact made her reports must-read material for investors and industry insiders, establishing her as a trusted voice in the tech sector. Similarly, Meredith Whitney gained prominence for her prescient warnings about the financial sector before the 2008 crisis. While not all of her subsequent predictions panned out, her deep understanding of the banking sector and willingness to challenge conventional wisdom established her as a respected voice in financial analysis. The investment landscape constantly evolves, and analysts who fail to evolve with it risk losing their relevance and credibility. Successful analysts demonstrate a commitment to continuous learning, whether mastering new analytical tools, understanding emerging industries, or incorporating alternative data sources into their research. Howard Marks, co-founder of Oaktree Capital Management, exemplifies this approach. His memos to clients, which span decades, show a consistent willingness to grapple with new ideas and reassess long-held beliefs in light of changing market conditions. This openness to learning and adaptation has solidified his reputation as a thoughtful, credible voice in value investing. While individual stock picks may grab headlines, long-term credibility is built on a consistent track record of thoughtful, well-reasoned analysis. This means going beyond superficial metrics and diving deep into the fundamentals of companies and industries. Jim Chanos, known for his successful short positions, has built his credibility on his wins and his research's depth and ability to identify structural issues in companies and industries. His early warnings about Enron, based on a thorough analysis of its opaque financial statements, demonstrated an ability to see what others missed, enhancing his long-term credibility, even when some of his other short positions didn't pan out as expected. Credibility isn't just about having good ideas, it's about communicating them effectively. Analysts who can distill complex ideas into clear, compelling narratives tend to build stronger reputations over time. Warren Buffett's annual letters to Berkshire Hathaway shareholders are masterclasses in this regard. By explaining his investment philosophy and decisions in plain language, Buffett has built a reputation for transparency and wisdom far beyond his impressive track record. Moreover, analysts who make themselves accessible, whether through media appearances, conference presentations, or direct engagement with clients, tend to build stronger relationships and, by extension, greater credibility over time. Maintaining ethical standards and independence is crucial for long-term credibility in an industry where conflicts of interest are rife. Elliot Spitzer's investigations in the early 2000s exposed how some analysts were producing overly optimistic research to win investment banking business for their firms, severely damaging the credibility of those involved. Analysts who maintain their independence, even when it means going against the interests of their employers or major clients, tend to build stronger reputations over time. Meredith Whitney's negative call on Citigroup in 2007, which went against her firm's generally positive stance on banks, enhanced her credibility when it proved accurate. As technology transforms the investment landscape, and analysts who embrace new tools and methodologies can enhance their credibility by providing unique insights. For instance, analysts who were early adopters of alternative data sources, such as satellite imagery for retail traffic analysis or social media sentiment for brand perception, were able to provide differentiated insights that boosted their credibility. While not a traditional stock analyst, Kai-Fu Lee has built significant credibility in the tech investment space by combining deep industry knowledge with an understanding of emerging technologies like artificial intelligence. His ability to bridge the gap between technological developments and their investment implications has made him a respected voice in tech and investment circles. While specialization has its merits, analysts who can contextualize their insights within the broader market and economic trends tend to build more robust long-term credibility. Ray Dalio of Bridgewater Associates has built his reputation on his firm's performance and his ability to articulate how economic machines work and how different asset classes interact. His all-weather portfolio concept demonstrates an understanding of market dynamics beyond individual stock picks, enhancing his credibility as a big-picture thinker. Building long-term credibility as a stock analyst is a multifaceted endeavor that extends far beyond the accuracy of individual stock recommendations. It requires consistency, intellectual honesty, continuous learning, and ethical conduct. It demands the ability to provide unique insights, communicate effectively, and adapt to changing market conditions. Perhaps most importantly, it calls for a willingness to think beyond short-term wins, to focus on building a body of work that demonstrates depth, integrity, and value over time. Analysts who achieve lasting credibility are those who view their role not just as predictors of stock movements, but as educators, thought leaders, and stewards of market integrity. They understand that their true value lies not in being right all the time, but in consistently providing thoughtful, well-reasoned analysis that helps investors navigate the complex world of finance. The human analyst role is evolving in an era of algorithmic trading and instant information. Those who combine deep fundamental knowledge with adaptability, ethical conduct, and effective communication will find that their credibility becomes their most valuable asset, one that appreciates over time, weathering the inevitable storms of market volatility and enhancing their value to clients and the investment community.